The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Christopher Cahill. Thank you for joining us today for our April 20th webinar, Things to Know When Buying or Selling a Home. I'm really psyched to have my good friend Jeff Rolk here from Gold Coast Mortgage to help us navigate the waters to the extent that we can. It's a crazy market, obviously, that we're dealing with here. So, Jeff, thanks for joining us today.
Thanks for having me, Chris. It's always a pleasure to talk to you guys.
Absolutely. So, we're always trying to provide timely and important and current content for you all. Hopefully you find this information helpful and insightful. Should you have any questions, please feel free to pass them through on the question button, and we'll do our best to answer them. If not, we'll make sure that you have a good view of our email addresses at the end, so you can follow up with us directly or yourselves if you'd prefer that. We can certainly do that. But we definitely want to be respectful of your time. We know that you're taking time out of your lunch typically to pay attention to this webinar. So without further ado, we're going to just kind of get right into it here. So as I said, my name is Chris Cahill. I'm a partner at 12 Points. I run the Family Office Services Group. I'm an attorney by training and background. I've done hundreds of real estate closings, so I know this space intimately. I'm also a certified financial planner and a chartered advisor in philanthropy. I work primarily with affluent individuals, a lot of lawyers, business owners, and C-suite executives on all manner of their planning, oftentimes centered around estate and trust, gift, business succession, etc. A lot of philanthropic planning, and I'm really pleased to have Jeff Rolk with us today. Jeff, why don't you give us a little bit of background as to yourself and what you do over at Gold Coast?
Absolutely. Thanks, Chris. I'm Jeff Rolk. I'm a 20-year resident of Salem, Massachusetts. I landed up there going to Salem State and almost 20 year. And I grew up in Metro West Massachusetts. I spent my whole life in the state of Massachusetts. And in 2015, I joined Gold Coast Mortgage, founded by my business partner, John Donlin, in 1999. Gold Coast is an independent mortgage broker, meaning that we are separate from any of the lenders. We act as a go-between to help our clients find the correct lender to suit their needs and their particular goals. And that's a little bit rare of a platform. And it's a little badge of honor for us to be able to call ourselves an independent firm in our industry. Cool fact about us was in 2017, we audited the license numbers for active mortgage licenses, and we were the 70th oldest mortgage company in the United States. So founded in 1999. Any of the big banks right now, Bank of America, TD Bank didn't exist in 1999, and Bay Bank and all the big banks back then are now something else. So, we've weathered a lot, and we're very proud of that.
That's an interesting point. I never knew that. That's great. Thanks. So we're going to talk today about buying and selling houses, right? So obviously Jeff comes at it from the mortgage arena. I come at it from the perspective of a financial planner and an attorney. But let's just talk about it from like brass tacks, Jeff. Like, big question that many people ask is how much house can we afford, right? Like, what should we be looking at?
Sure. So there's what you can legally afford, right? Like according to Fannie Mae or Freddie Mac or like federal licensing, how much of your monthly income, everything in a mortgage is based on monthly. So if your salary is $120,000, you make $10,000 a month, and we'll use that for round numbers. According to mortgage lending, if you're looking at a conventional loan, which anywhere in Eastern Massachusetts can go up as high as $770,000, you can use up to 50% of your income, so $5,000 on a mortgage payment. Do you want to spend 50% of your income on a mortgage payment?
Great question.
The job of, when people get referred to me, $770,000 is just a lot of money, but $5,000 a month is a real number. That's the number that's going to leave your checking account, and that's the number that you really, we have to direct our clients' attention to as quickly as possible. What's a realistic monthly payment And then we can reverse engineer the house. Do you want to put some more money down? Do you really want to have that much financed? Or do you need to reframe the purchase that you're trying to make? A lot of the financial planning world tries to prevent people's monthly recurring debt, which would be all of your credit cards, your car payments, your anything that's going to land on your credit report, including your mortgage, from exceeding that 32%. So 3,250 if your salary's 120. In the qualifying, all of those other debts come off the top. So again, if you have $5,000 a month, but if you have $500 in student loan debt and a $1,000 car payment, there's $1,500 out of that 5,000. So now there's only 3,500 that can go to the mortgage, and that's pushing you to 50% of your monthly income. The presumption is the other 50% is putting gas in your car and buying groceries and going out to dinner, the things that aren't, debt related. There's just like common spending. So the real answer is, what's the payment are you comfortable with, and then can you afford that payment on paper? Just depending on your income and how you're paid and how long you've been at your job. But the secret sauce is really just changing things to that real monthly payment and then discussing it with the client. What's your comfort level with that?
No, that's a great point. And from our perspective here, I mean, everybody has a different risk tolerance when it comes to investing. People have different risk tolerances when it comes to taking on debt and how much they want to hold and what type of debt they want to hold. For the last decade, we've seen a lot of folks that were accepting of risk, both in their investments and their mortgages. And I think that world's kind of changing. It certainly changed as it relates to mortgages recently. Everybody's focused in the world of fixed mortgages. And I know that's an area that you reside in and that's always been your preference, Jeff. So why don't we just spend a second before we pivot and talk about that for a minute? Because I think that's an important thing to talk about.
Our company is relatively conservative with the recommendations we make. And that leads us to fixed rate products are a sure thing. So again, that monthly payment is what's important to you. So what if you don't know what that monthly payment is? How do you commit to something, right? Currently it's not as much of an issue because a lot of the adjustable rate mortgages aren't as beneficial right now. Mm-hmm. With the extremely low fixed rates, a lot of lenders just shut them off. They didn't bother trying to write them. And now with the increasing environment, the writing's on the wall of why not do it. We're not planning for you to buy this house today. We're planning for you to own and live in this house indefinitely. So if we take a 30-year fixed payment, 20 years from now, you know what your payment's going to be, unless you pay the house down faster, and then the payment can just go away. But no matter what the economy does, no matter what interest rates do, your payment is going to be static and unchanging. If rates go down, you do have the option to refinance. But if rates go up, you're going to go to sleep at night feeling good about that. In an adjustable rate, you've got a 5, a 7, or a 10-year clock ticking. That rate's going to come up. And, over the last few years, rates have only had one direction to go, and they're going. So what are rates going to be 7 years from now? And do you want to ride out that adjustable rate mortgage that could potentially go from 3% to 8% in one payment? Or take a slightly higher interest rate and buy yourself a fixed position, right? Like an unchanging position that keeps your payment the same and keeps your life consistent, and potentially the best, biggest, most expensive asset that you're going to own.
Great point. And I think that's just something that we certainly here talk to all of our clients about during this process, and I know you do as well. It's just something to really focus on. Just certainty of result is really, really important. I mean, you're going to be taking a bunch of risk otherwise in your life. I don't see the need for doing it in your mortgage, to be honest. So let's talk about credit here. How important is good credit when somebody's applying for a mortgage and acquiring a house in this market?
Yeah, so we've calculated out some different kind of scenarios, and your credit on a 30-year mortgage can be worth $100,000 or more. So your credit score is a six-figure swing over the life of a mortgage, which is, fairly eye-opening to some people, but it's completely true. So.
And what do you mean by that? I think I understand it, but I just want to make sure everybody else does. Put that in like
so
real.
you have like mortgages are priced, and the pricing is based on two things: your loan to value and your FICO score. And so if you can imagine, there's a grid, and the high credit score and low loan to value, which means a substantial down payment. The more that you bring, the less. If the house is worth $1 million and you bring 20%, you owe 800,000. If you bring 50%, you only owe 500,000, which represents less risk for the lender because you have a more substantial position in the house. It's less likely that you'll default. It's less likely you'll make a late payment. It's less likely that they'll foreclose on you. So your rate improves based on that. And then your FICO score is a similar measuring stick. How risky or how stable is your use of your current credit? And the factors that go into that are utilization. So if you have a credit card that you can put $10,000 on, do you keep it up at 9,500 or do you pay it off every month down to zero? Ideally, you don't utilize any of your available credit cards more than 50%. And really ideally you keep them at around 30. So if you don't put more than $3,000 on a credit card with a $10,000 limit, your credit's going to react very positively to that. But it can also be changed very quickly by like a simple payment. So if you're going into a situation where you are going to apply for any type of debt, including a mortgage, taking a look at your card balances and your other debt and knocking them down below that 30% mark, if it's a possibility for you, will make an overnight difference. If we did that today and then your credit got pulled tomorrow, that payment would reflect already. Once it's gone, that your scores get recalculated instantly. So you have a lot of control over your credit as long as you're planning ahead. As long as you're getting out ahead of potential issues. So we love to look at people's credit and pre-qualify them, 6 months or a year in advance just to see what's under the hood, right? Is there any changes that we can make that may take some time? And then we've got time to make them. And if there's no changes needed, well, then great, we've got good news for you. But if you've got an accepted offer and you need to buy this house in 60 days, your credit's kind of what it is on that day, and there's not much you can do about it.
So let's talk about that. The whole importance of getting out in front of this stuff early, right? So obviously it's a really competitive market, as we know, for buying houses. People are coming in and making substantial bids above asking price, etc. How do you position your clients, Jeff, as it relates to being prepped for that? What sort of stuff do you do? There's all sorts of things, pre-qualified, pre-approved. Tell us about that stuff.
Yeah, so the keys to success, if you're going to finance, right, cash has obviously got its advantages. You can close really quickly. Some people, if the funds are available, will buy a house cash and then we'll put the mortgage on it after the fact, right? Like I've had cash buyers walk into a purchase pre-approved for refinance afterwards to reflush their investment accounts, or the parents might step in and give them a gift and then they'll pay that gift back. But that's one strategy that's available. The others are who's on your team. So having a good solid pre-qualification or pre-approval letter from a smaller firm like ours is I've noticed an advantage. The very big, very slow moving banks in the country, like the really big ones, they don't move fast enough to close on time, and realtors are acutely aware of that. Mm-hmm. So your offer may carry a little bit less weight than if it's a company where if you pick up the phone, that person's going to answer. And then your realtor plays a huge role. Yeah. Is your realtor well known and well versed in the area that you're trying to buy? A lot of people might move from the North Shore down to the South Shore and they've had a great experience with their realtor up here. but your reputation of the realtor's offer actually carries a fair amount of weight, and from the perspective that the other realtors in that area know that they're going to vet a client and they're going to have had a call with me about my letter that I provided. And then they're going to confidently say, like, yeah, this loan's going to close, because in real estate, nobody gets paid unless somebody buys the house. So if you've got an unknown quantity in, the realtor who's making the offer, an unknown quantity in the mortgage company, their comfort level is going to be a little bit lower than, maybe an offer that's off by 2 or 3%, but these people are sure that this business is going to be more likely to close. So, the playbook is really, a good local realtor is a lot of strength. And, just feel free to interview and ask people that that may live in that area. But that's a big recommendation that I always make. And then, the attorney's office plays the final role. Attorneys are kind of licensed by state, like the mortgage companies are. And they can be a little bit more remote, but make sure you're using an actual real estate attorney. Every attorney can technically do a real estate closing, but when something goes wrong in a purchase, you can't have this be like somebody's first crack at it. Like,
No.
Real estate attorneys steam through problems on a daily basis for us. And that partnership is very important. And again, it's going to cause less stress to the client, and it's going to cause more success for the actual purchase itself.
Yeah, I completely agree with all of that. Certainly with the attorneys, you do not want a general practitioner doing your closing. Closings, for the most part, are pretty smooth sailing. There's some standard changes that are made both on buyer and seller sides. But by all means, you want somebody that's primary practice, if not exclusive practice is focused in the world of real estate, residential closings, because they really will be able to handle all manner of things that come up. And trust me, weird stuff can happen at closings, and you want somebody that's got your back. So let's talk about like the obvious annual costs, right? How do you factor this stuff into that discussion that we had a moment ago about how much can you buy? Like we talked about the mortgage amount, but there's other stuff, right?
Yeah, so your mortgage, the term is PITI. So it's your principal, interest, taxes, and insurance comprise your mortgage payment. And that's what you need to qualify. So even if you're not going to have an escrow account, even if you're going to pay your taxes on your own, you still have to qualify with that tax payment and the insurance payment. So you have to provide that you're insuring the house. That's one of the requirements of even getting a mortgage, is the house is protected. Because that lender is co-investing with you in the house, so they require it. Mm-hmm. So if you're looking at a house online and you've been pre-approved or pre-qualified, and your representative there, your loan officer, has here's the rough interest rate that we're looking at. If you say put 30% down, you'll get this rate right now, which is currently updating on a daily basis, but you can use a very basic loan calculator that's probably already on your phone. So you say, my loan amount is $500,000 at this rate. Here's the payment. And then depending on the area you live in, insurance is relatively static. For a house that doesn't have any really abnormal amenities to it, you could look at around $100 a month for insurance, and you might end up at 90, and you might end up 105, but 100 a month is pretty fair. So take your principal and interest payment on that calculator, add $100, and then if you just go online to any of the available websites like Zillow or Redfin, the taxes are listed there annually. So you take this year's taxes and divide that by 12, add that to the payment, and now you have your principal, interest, taxes, and insurance. So part of the training when we do the pre-qualification is arming the clients with the ability to kind of go around and look at houses in different towns. So an exercise we do a lot is somebody says we want to kind of live in the Westford area. So you go find 4 houses in the 4 towns in that area that are relatively the same, say 3 bedrooms, 2 bathrooms, meet your criteria that you'd like to buy, and do that exercise on all of the houses. So even if the houses all cost the same, the taxes can be substantially different. Mm-hmm. And taxes often are driven by school systems. They're driven by, kind of the town's expenses to operate. Is it a city? Is it more of a rural town? Mm-hmm. and they're noticeably different on the same house. So, for instance, if somebody's going into their retirement home, maybe buying into the town that has like one of the best school systems in the state might be unnecessarily expensive for them because the taxes are going to be noticeably higher in most cases. So would you maybe want to live in the town next door that doesn't necessarily have a exceptional school system because it's not really relevant to you? And then the clients have the ability now to kind of go and investigate each house in a fairly objective way. Maintenance, the fourth category there, is not associated necessarily with the mortgage process, but it's just something you have to be aware of. One of the home inspectors I use a lot says essentially you got to put about 3% of the value of your house back into it every year on average.
Mm-hmm.
So if you're painting the whole outside, you might be above 3%. If you just painted last year and you're just doing a little landscaping or minor repairs, you're probably below that 3%. But just sort of be prepared to have that number pop up when you have a plumbing issue and you have a utilities issue and you have an appliance issue. Houses cost money and houses require maintenance. So you just need to be prepared for those costs, whether it's a slush fund in your investments or money that you keep in cash or a savings account. But you should just be prepared that things break.
They do, and even if you can get by a couple of years, before you know it, that deferred maintenance will raise its ugly head, and you'll have to deal with it, whether it's a $10,000 heating system update or whatever it may be. But home ownership is not for the faint of heart. But
no, and you got to remember too, like someday you're going to sell this.
Mm-hmm. Yeah,
and deferred maintenance, it might harm your sale price by more than the actual cost of the maintenance.
Yeah.
So
you got to live there, right? And that's the other thing, and you got to enjoy it, right? So, I just think that having a place that you pay attention to and that you care about shows and in all respects. So, excellent. Thanks for that. And let's talk about, we've kind of touched on a decent amount of these topics here, but the process itself. So, let's talk about the team, the down payment. We've touched on variable and fixed, but we can do that again, and definitely talked about points. So let's hear about all that stuff.
So the mortgage team is, we touched on it briefly. So you have the realtor, you have the attorney, and you have the mortgage professional, the loan officer. And those three firms kind of build the safety net around the client. Yep. So when you make an offer, you're going to give probably $1,000 check. And if your offer gets accepted, that check goes into an escrow, and that will count towards your down payment by the closing. And then when you sign the purchase and sale, you're going to give a 5% deposit in most cases. So that will go into that same account, and that 5% will count towards your down payment. So if you put in 20% down, you'll bring 15% down to the closing, and then your closing costs and whatnot will be in that check as well. So you need to be prepared that some money needs to be immediately available when you're making offers on a house so that you can write this check. Your down payment, we also touched on a little bit, just like your credit score, your down payment is going to affect the rate that you get and the terms that are available to you and whether or not you'll pay mortgage insurance. So mortgage insurance is an insurance that covers the difference. If you don't have 20% to put down, if you're going to put down 5% or 15%, mortgage insurance is like gap insurance for that payment. So statistically, your likelihood of default on a loan goes down dramatically once you own 20% of your house, once you have 20% equity. So if you're going to buy a house with 15% equity, the lender institutes a insurance payment that will cover that gap between 15 and 20%. Once you reach that 20%, the insurance will just go away. And this is on a conventional loan. So the barrier to entry on most conventional products is 5%. So 5% down is a great goal. Mm-hmm. If your credit score is high, the insurance is less expensive because your credit score is stepping in and saying this person is lower risk of not making payments. They've got a great payment history. They've got great use of their credit. They've financed other things in the past and there's been no problems. So a high FICO score, again, saves you on the mortgage insurance if that's necessary on your purchase. And then your down payment is also a factor on that grid for how your interest rate's calculated. So the more you put down, the lower risk you are, and the lower risk you are, you in turn get a slightly better interest rate. And it's not going to be like 1%, but it'll be 0.25% possibly better rate, which is a moving target, but it's generally like if you're putting 10 or 20% down, you might see 1/8 to 1/4%,
which is huge.
Lower interest rate the more you put down.
Yeah, over the course of the loan, that's a big deal. So I'm glad you brought up the idea of or the discussion of the mortgage insurance here. That was a question that just came through actually. PMI is that private mortgage insurance is particularly expensive, and it's one of those things that people try to get in and out of as soon as they can, right? Like, I mean, if you have to have it,
the actual price of it has been lowered in the past years, so that's a positive, which makes it a little lighter on. Most people that see it are people that are buying for the first time.
Right.
If you have equity in your house to strip out when you sell it, you're bringing that equity to the next purchase. So that's the starter home sees the PMI more often. So again, the things that are under your control are your FICO score. And, if you take a year off of your search to save up some more money, you can either get out from under PMI completely or pay less of it. But getting all that stuff in place, again, 6-12 months ahead of time, you're gonna have a better experience because you either know that it's coming or you've done whatever you can to avoid it completely.
Perfect. So let's talk about the mortgage term. I've been hearing a lot, and I've even been reading a decent amount about 40-year mortgages. Is this something that you're seeing?
I have not seen them at the retail level yet. I haven't seen them offered to clients, and not even by like lenders that we're not connected with. So every once in a while, there's somebody with that new product that's trying to get on our menu.
Right.
And I haven't seen the 40-year mortgage.
Just seems like an absurdly long time.
The prices are fairly high right now, so that might help some people with qualifying, but I don't know when or if. I don't have any insider information on that.
All right, cool. How about points?
Sure. So the term a point, 1 point is equal to 1% of the amount of your mortgage. So not your home price, but the loan. So again, if your mortgage is $500,000, 1 point is $5,000. And then there's terms like paying points or no points. And that refers to your interest rate relative to any costs. So let's suppose that your closing costs on a $500,000 loan are $2,500. So that would be half a point. The no points rate means that there's no additional cost to get that interest rate. Mm-hmm. So for round numbers, let's say that interest rates are at 5% and you have half a point in closing costs. So your $500,000 loan has $2,500 in closing costs, and 5% is a no points rate. So that means you'll get 5% and you will pay $2,500 at the closing to close that loan. And you say, well, I don't want to spend the $2,500. So then we go, well, what is the credit at 5.125 on $500,000? So as you go up in rate, the credit will increase. Mm-hmm. And so 5.125% may have a credit of $2,500 or $2,300 or $2,100. So then you say, okay, for that, I'll pay the $400 or the $200 that's missing there. And now I only have $200 in closing costs. So the phrase no points, no closing costs simply means we selected an interest rate with a credit big enough to cover all of your closing costs. And then the other side of that is paying points. So if you say, well, I want 4.75%, the lender is going to have a price for that. So then you can buy your rate down. Mm-hmm. The $500,000 loan, it might cost a point and a half. So $7,500 to get that 4.75 plus your closing costs. So now we're into it for $10,000 at the closing to get that lower rate. And paying like a fractional point, we can, usually make the math work, but the true cost is now you have, again, a time set on how long you have to stay in that house. If you paid $7,500 in points and your payment changed by $50 a month, right, to go from 5% to 4.75, 50, that's 150 payments before that goes positive on a 360 payment loan. So you've got 12 years before. If you sell that house in 7 or 10 years, you actually lost money because the points are cost, an immediate cost. So, and then at 12 and a half years, you've just broken even. Now you need another 12 years for it to have been worth it for $7,500. So in a lot of cases, my guess is you can do better with that money somewhere else. And we're generally inclined to encourage our clients to, not pay a point to lower their rate, or, if it's like, you can get where the next rate down is like 3/100ths of a point. So it's like for $75, you go from 5% to 4.875. And it's like, yeah, absolutely. Because if the difference is $35 a month, like month 3, you go positive. That's no problem. But to just pay a point, generally the math is pretty unappealing once you break it down that way.
Yeah, especially in light of the fact that most people tend to bag out of their mortgage or sell the house within 7 years anyway. So
correct. Yeah, the average mortgage lives about 7 years, and people refinance or people move, they change jobs, they get divorced, they get married. There's all these factors that are external that drive real estate, a lot more than rates do.
Yeah.
So, when rates are high, people get a mortgage with a high rate, and, we don't have control over that. But, I always try to mention the things you do have control over, and that's what's important to focus on. That's your credit score, that's your down payment, that's your savings, that's your income. There's all these things that contribute to you succeeding. And, the interest rates, essentially, they'll be what they are on the day that you find your house. Like, there's nothing you can do to change the interest rates.
No doubt. And I mean, we're also in that weird environment that most of us have never been in, honestly, where rates are going up, right?
Yeah, it's been a while.
It's been a long time. So, it's gonna certainly be a bit of an adjustment period for all manner of people, buyers, sellers, and people in the industry. So this is going to be an interesting thing. So here's some tools and trusted resources that we'd like you to kind of just jot down if you can. The mortgagecalculator.org is a good one. Certainly lenders and mortgage brokers have a lot of expertise. People like Jeff that we work with regularly can bring to the situation as evidenced here through this conversation. Is there, from your perspective, a difference, Jeff, of working with somebody like yourself versus a big bank? Let's just talk about that and then talk about.
So it's, our ability to pivot is really good. My company is a total of 4 people. So it's pretty impossible that the client gets lost in the shuffle here. So if my business partners, John or Matt, are working with a client and they're not available, I'm completely capable of stepping in and taking care of something for that client if it's time sensitive. And that keeps them on track, and that keeps their purchases and their refinances from overrunning closing dates. And, it keeps them feeling cared for, which is important to us. Your individual loan officer plays a really large role. So, if somebody's in a state that, I'm not licensed in, it's important to just have an interview. Make sure you feel like they're listening to your goals and giving you good information. Like the monthly payment stuff, like that's what should be important to the end user, the client. That's the check that you're going to write every month. So, everything else, the interest rates, your purchase price, your your loan to value and everything is just a factor that winds up in producing that payment, but the payment's the real number to you. So, once you kind of get your head around that number, you'll be able to move forward. And then, the difference between companies is just, read your reviews online.
Yeah.
Do they have a reputation for closing on time or not? Do they have great customer service? Like, do people take the time to write good reviews, or are they, writing bad ones? So that's the other important factor is, people are voicing things online more than ever. And so it's pretty transparent. So just make sure you take a look.
So thanks for that. Property insurance is one of those things that many people kind of overlook until like the very end, and they realize, oh crap, I got to insure this place. Let's talk about what type of coverage is necessary. Yeah, I guess we should just talk about that for a minute.
Yeah, so it's like it's based on replacement cost of the house. So like if the house burns down, you need to build a new house. So you need to have enough insurance to accomplish that. And similarly, any good local insurance agent is going to have no problem putting together a policy that is correct for you and your needs. Some of our toughest incidents are the national size firms that kind of have national broad brush rules for their company, which Massachusetts can differ from. So they will give clients a policy that's not sufficient according to the state of Massachusetts. And then we have to make changes, and then that stuff like that can again jeopardize your closing date, because if it's not correct, it can't close. So, hire local and, get recommendations from other people in that area and, have that team in place ahead of time so that when you find the house, if the attorney says, I have a great insurance agent that's in that town, you're already off to a great start. But calling an 800 number that, advertises when you're watching golf really might not provide the type of service that you need when you're under the time constraint to close on a house. Special conditions and stuff, flood insurance, you need to be aware of that. So if the house is near water, there's free flood maps. You can just check, is this house going to require flood insurance? Your realtor should be able to tell you whether the house requires flood insurance or not. So just be aware of it and know that payment's coming. If you're going to have financing on a house that's touched by a flood zone, you're going to be required to pay flood insurance.
Perfect. And speaking of realtors, we've already touched on this a little bit, but I think it's really, really important to understand their role in the process. So why don't you take us through this from your perspective, Jeff?
So like I said, it's important that they're hyper local to the area that you're buying in. If you're making a purchase, your realtor in Massachusetts at least is free to you. They are paid by the seller. So when you go to sell a house, you pay both realtors. Generally, their fee is roughly 5% of the purchase price, and then that's split between the buyer's and the seller's realtor at the closing. Their commissions can be negotiable, but it's pretty static. It's a fairly standard number. And they're a great value to you when you're making a purchase. If you find a house that's off market, if you find a friend of yours, aunt and uncle, that's going to move to Florida or going to downsize, and you can just purchase the house from them directly, then you'd only need an attorney and the mortgage person involved in the deal. The attorney would just draft the purchase and sale, and then they would execute on it with the mortgage person. So that's in an environment like this that's so competitive, that's advice I give a lot of clients, is just tell everyone the town that you want to live in, right? What's the area? Because somebody may have that aunt and uncle, somebody may have friends, mom, like whatever it is, but somebody might be selling a house. And, the appeal to them for you as the buyer is no matter what price you settle on, they will get 5% more than that because they won't be paying any commissions. And the advantage to you is you are eliminating that bidding war that might drive it out of your price range. So you can have a fairly civilized off-market deal and they're probably more common than most people think. So, if you're in a shopping mode and you're paying attention to like Zillow and you're just watching, the town of Wenham, and you see everything that comes on the market for 2 weeks, but then you click on historical, what's sold in the last 2 weeks or 2 months, there's significantly more houses have been sold than have been on the market. And once they change their status at the registry of deeds, it'll show up as a sold property. There's a new owner, there's a new deed. So you can kind of flush out how often it's happening. And then, if you can participate in that, you could potentially get a pretty civilized and pretty fair deal on a house. So that's a great advantage if you can engage in it.
No, that's great advice. I will tell you, we tried to purchase the house that we're in now that way. The seller, unfortunately, had different opinions. They wanted to pay their friend the broker. So I got introduced to them through somebody that wasn't a broker, was off market, and they were like, nope, we're putting it on and you can buy it through her and pay her. I was like, okay. We ended up loving the house and we did it, unfortunately, but I completely agree. Off market deals are wonderful. So we're going to try and rip through the last couple of slides here. So cash at closing, we've talked about this. You're likely going to need to bring a check.
Yes.
How much you need to bring is going to be dependent upon how you structured the deal, right? Like to the extent that you just described the no-no closing, you're not likely going to be bringing a big check, but that does not mean you're not bringing a check, folks, because guess what? You're going to need to pay for your, if nothing else, the escrow adjustments, the taxes, your insurance, those things that aren't covered by the closing costs, quote unquote. So it's what's all disclosed on the HUD settlement statement that the attorney will prepare for you. They're supposed to send that to you at least 24 hours in advance. Oftentimes it's a scramble and you're going to be getting that last minute, but you really need to know what the numbers are. But by all means, expect to be bringing cash to the closing, right?
Yeah. So you figure in addition to your down payment, about 1% of the purchase price, give or take, is your additional costs.
Right.
So you have closing costs, and then you have the escrows, like you mentioned, which are your taxes and your insurance. And those are distinctly not closing costs. They're in a different category. Those are your responsibilities as a homeowner. So even if you didn't get a mortgage at all, you'd still pay taxes on your property. And if you didn't get a mortgage at all, it'd probably be sensible to insure that property. So the escrow account simply makes that part of your monthly payment, and you have to pre-fund it because your insurance is paid annually. So you pay your first 12 months at the closing, and then you put an extra 2 months roughly into the escrow account for an overage in case your insurance goes up. And then same with taxes. In Massachusetts, they're paid quarterly. So you would put, depending on where you close in the tax cycle, today, April 20th, if I bought a house, the sellers would owe taxes up until today. And starting tomorrow, I owe taxes. So that's calculated to the day, and the changeover happens. And then the next tax bill is due, I owe the rest of that. So you got to be prepared, and taxes rarely go down. So again, they'll put an overage in that account, and then every month you'll pay 1/12 of your taxes and 1/12 of your insurance bill. And then the lender will annually and quarterly cut the appropriate checks to the insurance company and the city you live in.
And you can get out of that, right? So you don't need to escrow.
You don't have to escrow. No, to qualify, you have to have the payments and you have to be known to you. But you can pay your taxes yourself. Just write a check to the city every quarter and pay your insurance on your own. Yes.
Excellent. And so we've talked about this, but obviously, you folks, you need an attorney. You need an attorney. You're not doing this on your own. And obviously, Jeff indicated you want to work with reputable realtors, but sometimes in certain markets and certain realtors will try to kind of get you to just get you hyped up and say, hey, this is really a hot property. We got lots of offers. We need to sign an agreement right away. You don't want to be rushed into anything here, right? So these next couple of slides are going to be talking about things where you don't want to be rushed. So
Yeah.
you need a qualified attorney that we discussed, somebody that specializes in real estate. You need to recognize how the process works. And the process works like this, as Jeff indicated. You'll make an offer. If the offer is accepted, you'll be providing some earnest money, typically $1,000, to just kind of hold it. And that says that we're going to agree to the terms of a purchase and sale agreement a week out. So that's when your attorney is going to be negotiating with the seller's attorney or vice versa, and putting together an agreement that makes sense for everyone. There are standard changes, as I said earlier, that are really, really important to protect you as the buyer and as the seller. So you want to pay attention to that, and you want to make sure that you have somebody that's paying attention to those nuances. But you really do not want to ever sign an offer and then a purchase and sale agreement, I should say, without having an attorney mark it up for you, because what you don't want to do is find, something bad could happen, right? You might not qualify the mortgage that you thought you were going to get, you might not get. And unless you've had an attorney represent you properly, you could be on the hook for buying the property, even though you can't technically afford it now. There's standard changes that are made that would say that if that were to happen, the whole amount of damages to the seller would be your deposit. Nobody wants to lose their deposit, but trust me, it's a whole lot better than being forced to buy a house that you can't afford. So that's what's called specific performance. You don't want that to happen to you. So you definitely need an attorney. And we also have touched on this, but you're going to need an inspector. So let's talk about the importance of an inspector, especially in light of where we are today, Jeff.
Yeah, so your home inspection is different from your appraisal. So your home inspection is information for you as the buyer about this property. Are there any repairs? Are there any additions that were done incorrectly? Is everything up to code? They'll go through and just investigate the wiring. What's the age of it? What are the ages of all the utilities in the house? What are the ages of all the appliances in the house? And, just what are things that you need to be watching out for, right? Like every single basement needs some repointing if there's any type of stone or concrete in it. Like there's a brand new construction house is going to have things on the home inspection, because no house is perfect. But the information that you get is really important. And one thing that's becoming more and more common is the sellers are wanting people to waive the home inspection. So they're saying, I want you to tell me that you'll buy the house as is without having a home inspection done. And, my comfort level with that is fairly low. So
Same.
Solutions are, a lot of home inspectors will do kind of a guerrilla inspection. If you go to an open house and you really enjoy it, you could pay them a fee to go to an open house, and they will simply walk around the house and look for major things. So they're not going to go through and be able to test every outlet in the house and fill out their detailed inspection report like they would.
Mm-hmm.
But what you need to know is, are there any $50,000 problems, right? Roof and foundation. Are there any $10,000 problems, right? Floors that need to replace, walls that are going to fall down. And are there any, $5,000 problems with the house, right? Old windows, a door that's not weather sealed correctly, possibly like mold, all kinds of things that they'll just be able to walk in and look at and say, like, there's your problem right there. And then if you've got that done and you're either problem free or comfortable accepting those problems, you make the offer and waive the home inspection.
Mm-hmm.
And that way you've got some peace of mind. Unless you're personally a general contractor and able to walk around a house and inspect it yourself, that's a pretty streamlined solution that will get you where you need to be, right? Make you confident in the offer that you're making. Similar with the repairs, right? If the home inspector brings up something that's a substantial issue, you would write your offer highlighting it and say, like, listen, we would expect a cost of this much for the back roof to be replaced. Would the sellers either have that done or give us cash back at the closing to do that, right? So if the sellers cover $4,000 of your closing costs, that's $4,000 you don't have to pay. which means you have $4,000 to repair the roof. So can you be compensated for that? And that's part of the offer practice to get you to purchase and sale. All those things have to be ironed out by the time anyone will sign the purchase and sale. What's important is that you, as the buyer, are aware of it. So you can negotiate if needed. Just going in and saying, we'll waive inspection, you know, the house looks great. There's potential issues lurking that you might be unaware of, and you know, it's not a small amount of money. So
that's a huge risk. There's no doubt about it. And you know, everything is negotiable by all means. Certainly, depending upon market cycles, the appetite for negotiation is either small, medium, or high. And I would say to you right now, the appetite is non-existent for the most part. So good luck with that. And, you know, with that being said, we're just going to kind of round the horn here and get to the end of this thing. So, you know, is it an optimal time to buy or sell from your perspective? What are your thoughts about the market in general and timing? And
it's pretty hectic. So it's not a bad time to sell. Prices are the highest that they've ever been. So that's great for sellers, but where are you going to go? You know, there was a day 2 weeks ago where Beverly, where my office is, there wasn't a single family home for sale. Everything had been bought. So that's somewhat unheard of. And prices are high. So if you're selling a house, you're just transferring the gains that you've made into this next house, which has also made those same gains. So, you know, it's just kind of something you need to accept. You can't really time the real estate market any better than you can time any other market, which, you know, as Chris will tell you, isn't the best use of somebody's time trying to do. So the things that drive real estate, again, are external of that. Like, if your job takes you somewhere else and you need to move, well, then you need to move.
Right.
If your family has exceeded the capacity of your house because your in-laws moved in with you or because you had triplets instead of one kid, not much you can do. You're going to move. So you just need to be able to find the house that's going to work for you at that time. And all the other factors, the rates, the cost of the home, the prices, those are beyond your control. So you just need to plan on the things that you can plan on, improve the things you can improve, and that will give you the best process for when that need arises to make the purchase on the home.
Well said. Well, listen, Jeff, great time here today. As always, you did an awesome job. We're coming up on the hour. I don't see any additional questions at the moment. I'm going to just thank you for your professionalism and your knowledge in this space and taking the time to help us put together the presentation and do it here today. And certainly thank everybody for attending. We'll be downloading this and putting it on our website. If anybody's interested in a replay of this, just let us know. Happy to get it to you. Thanks again, everyone, and particularly to you, Jeff. Thanks so much, my friend. Talk to you soon.
My pleasure, Chris. Enjoy your day.
Thanks, same. Bye-bye.